Most traders believe risk management is a technical skill. They think it is about numbers, about where to place a stop loss, about how much to risk per trade, about position size. And while all of that matters, it is not the real challenge, because most traders already know these things. They know they should risk small. They know they should not move their stop loss. They know they should stay consistent. But when the trade is live, when the market starts moving, when money is involved, something changes. Emotion becomes stronger than logic. And in that moment, they stop following what they know. This is why so many traders struggle, not because they lack knowledge, but because they lack mental control. Professional traders understand this deeply. That is why they do not just manage risk. Technically, they manage risk mentally, and that is what keeps them consistent over time. In this video, I want to explain something very important: how professionals manage risk mentally. How professionals manage risk mentally. Because once you understand this deeply, your behavior in the market will begin to change. You will stop reacting emotionally, and you will start acting with discipline. If you stay with me until the end of this video, you will understand how professionals think about risk, how they stay calm under pressure, and how you can build a mindset that protects both your capital and your confidence. And if you want to continue building a strong trading mindset, consider subscribing to Bull Mindset. This channel is focused on trading psychology, discipline, and long-term consistency.
Now let us begin with a simple truth. Risk is not controlled during the trade. Risk is accepted before the trade. This is one of the biggest differences between beginners and professionals. Most traders enter a trade hoping it will work. Professionals enter a trade already accepting that it might not. This small difference changes everything, because when you accept the risk before entering, your mind becomes calm. But when you do not accept the risk, your mind becomes reactive. Every small movement feels important. Every red candle creates fear. Every fluctuation feels like danger. Now let us go deeper into this idea. What does it really mean to accept risk? It means you decide in advance how much you are willing to lose, and you become mentally comfortable with that loss, not just logically, but emotionally. Because many traders say they accept risk, but when the trade goes into loss, they feel discomfort, they feel tension, they feel the urge to act.
That means the acceptance was not real. Professional traders make this acceptance real. They visualize the loss, they prepare for it, they understand it, and because of this, they are not surprised when it happens. Now let us talk about uncertainty. The market is uncertain. There is no way to know what will happen next. Every trade has two possible outcomes. It can win, or it can lose. Most traders struggle with this. They want certainty. They want to be right. They want to avoid loss. But professionals accept uncertainty. They understand that trading is a probability game. They do not try to control the outcome. They control their behavior. Now, let us talk about emotional triggers. Most traders react emotionally when they see loss. Even a small loss can create discomfort. The brain is designed to avoid pain, so it tries to fix the situation. It tells you to close the trade. It tells you to move the stop loss. It tells you to do something. But these actions come from emotion, not from logic. Professional traders recognize this pattern. They understand that the urge to act is not always correct, so they pause, they observe, they allow the trade to play out.
Now let us move into real trading examples. Imagine a trader who enters a trade. The setup looks perfect. Everything aligns. But after entering, the trade moves slightly against them. Immediately, they feel uncomfortable. They start doubting their decision. They close the trade early. Later, the market moves in their direction. This creates frustration. This is emotional decision-making. Now imagine a professional trader. They enter the same trade. The trade moves against them. They do nothing, because they already accepted the risk. They allow the trade to reach the stop loss or target. Over time, this consistency builds trust. Now let us consider another situation. A trader experiences two losing trades. They feel pressure. They want to recover quickly. They increase their risk. They take a low-quality trade. That trade also loses. Now the loss is bigger. Now the emotional damage is higher. Now imagine a disciplined trader. They have two losing trades.
They do not change their risk. They do not change their behavior. They continue following their system. They understand that losing streaks are part of trading. This is mental risk management. Now let us talk about another important concept. Professionals separate execution from outcome. This is very powerful. They do not judge their trades based on profit or loss. They judge their trades based on whether they followed their plan. If they followed their rules, it is a good trade. Even if it lost, This removes emotional pressure because they are not trying to be right, they are trying to be consistent. Now let us talk about consistency. Consistency is not about winning every trade. It is about executing every trade the same way. It is about following your process. It is about controlling your behavior. When you are consistent, your edge has a chance to work. When you are inconsistent, even a good strategy fails.
Now let us talk about another key idea. Risk control protects your mindset. When losses are small and controlled, your confidence remains stable. You are able to continue trading with clarity. But when losses are large and uncontrolled, your confidence drops. You become emotional. You start making mistakes. This creates a cycle of poor decisions. Professionals break this cycle by controlling risk. Now let us talk about mental frameworks that support this mindset. The first framework is acceptance of uncertainty. You must accept that you do not know what will happen next. This removes the need to control the market. The second framework is process over outcome. Focus on your actions, not the result of one trade. The third framework is consistency. Treat every trade the same way. This builds discipline. The fourth framework is emotional neutrality. Do not let wins make you overconfident. Do not let losses make you fearful. Stay balanced. Now let us talk about practical exercises to build this mindset. One powerful exercise is pre-trade acceptance. Before entering a trade, say to yourself, I am willing to lose this amount. This prepares your mind. Another exercise is fixed risk per trade. Decide your risk percentage, and never change it based on emotion. This creates stability. Another helpful practice is journaling. After each trade, write down your thoughts. Write down your emotions. This builds awareness. Another exercise is pause before action. When you feel the urge to interfere with a trade, pause. Give yourself time. This reduces impulsive decisions. Another important exercise is reviewing your worst trades. Look at your biggest losses. Ask yourself, did I follow my plan? Or did I act emotionally? This helps you improve.
Another powerful habit is creating a routine. Before trading, prepare your mind. Define your plan. During trading, follow your rules. After trading, review your behavior. This structure supports your mindset. If this video is helping you understand risk management in a deeper way, consider subscribing to Bull Mindset, because managing risk mentally is what separates professionals from beginners. Now let us talk about something deeper. Trading is not just about the market. It is about you. It is about your reactions. It is about your decisions. The market will always be uncertain, but your behavior does not need to be. And that is what professionals understand. They do not try to control the market. They control themselves. Now let us move toward the final message. You will have losing trades. You will feel discomfort. You will face uncertainty. This is part of trading. But your behavior does not need to change, because your success is not based on one trade. It is based on how you manage risk over many trades. Encouraging. Let me leave you with one final thought. You do not need to predict the market. You need to control your mind. Accept risk before entering. Stay disciplined during the trade. And stay consistent over time, because that is how professionals manage risk mentally. And if you want to continue building that mindset, subscribe to Bull Mindset. I will see you in the next video.